Today we'll be looking at Module 9. We are gradually coming to the end of this course, International Finance. Today we'll be looking at Module 9, which is Emerging Financial Markets and Global Investments. By way of module objectives, by the end of this module, students should be able to, one, understand the key characteristics of emerging markets, including their economic, political, and financial features, analyze the investment opportunities in emerging markets, including the types of assets that offer the most potential growth potential. Students should also be able to identify and manage risk volatility in emerging markets through appropriate investment strategies. Students should be able to examine the impact of global economic shifts on emerging markets and the financial market as a whole. Students should also be able to assess the risk and reward of investing in emerging markets and understand the strategies for managing those risks. By way of introduction, emerging markets are characterized by rapid economic growth, an expanding middle class, and increased integration into the global economy. These markets, found primarily in developing countries, offer both high potential rewards and considerable risk for investors. Over the past decades, emerging markets have become a critical component of the global financial landscape, driven by factors such as technological advancements, urbanization, and liberalization of financial systems. The term emerging markets refer to countries that are in the process of industrialization and economic growth. With rapidly developing financial markets and expanding trade and investment opportunities. This module will explore the characteristics of these emerging markets, the investment opportunity they present, the risk associated with market volatility, and how global economic shifts impact financial markets. Using the dynamics of emerging markets is crucial for investors looking to diversify their portfolio and capitalize on the growth potential of these regions. What are some of the key characteristics of emerging markets? One, we have rapid economic growth. That is, there's higher than average growth driven by industrialization, urbanization, and a rising middle class. Two, there's market liberalization. Government is involved in reducing trade barriers, privatizing state-owned enterprises, and improving regulatory frameworks to attract foreign investors. Another key characteristics of an emerging market is financial market development. We have stock exchanges, we have bond markets, we have banking systems. They are all developing, but may be less advanced than developed markets. We have political and regulatory risk. We have political instability under this. We have corruption. We have frequent changes in regulations that make these markets riskier for investors. Now let's look at some of the rising middle class. Rising middle class is another key characteristics, rather. The expanding middle class drives consumption, creating opportunities in retail, technology, healthcare, and education. This is a diagrammatic representation of the characteristics of emerging markets. There's rapid economic growth, industrialization, developing infrastructure, investment opportunity, large young population, global integration, technological adoption, and investment opportunities. Let's look at investment opportunities in emerging markets. We have equity. These are stocks of companies in rapidly growing sectors like technology, manufacturing, and consumer goods. There is high potential for returns. There are an opportunity is in fixed income security. Bonds issued by governments and corporations, higher yield compared to developed markets, but with increased risk. Then we have private equity as an opportunity. Investments in privately held businesses, particularly those in their early or expansion stages, offers high returns but require long-term commitments. Then we have real estate opportunity here. This is growing urbanization and infrastructural development, offering profitable real estate opportunities in residential, in commercial and industrial sectors. Then we have investment opportunities in commodities. This is investing in commodities such as oil, metals, and agriculture in resource-rich emerging markets. Then let's look at market volatility in emerging markets. The factors driving volatility include political stability, inflation, currency fluctuations, and external economic shocks. There is risk of sudden market corrections. The rapid growth in emerging markets may be accompanied by sharp declines when market condition changes. An example is the Asian crisis of 1997. Some countries like Thailand and Indonesia faced severe economic turmoil, affecting investors worldwide. How do you manage volatility? Use strategies such as diversification, currency hedging, and active portfolio management. These are key for managing risk in these markets. Then let's look at investment strategies to manage this volatility. Like I said, we have one, diversification. This is spreading your investment across different countries, industries, and asset classes to reduce risk. Then we have hedging currency risk. This is using derivatives like forward, options, and swap to protect against currency fluctuations. Then we have active management. This adjusts portfolio in response to changing market conditions and risk. Active management allows for flexibility and responsiveness. Then we have long-term investment horizon. Be patient and allow investments to mature despite short-term volatility. Emerging markets offer long-term growth potential. Now let's look at global economic shifts and their impacts on emerging markets. We have interest rate changes. This is rate hikes in developed countries, especially the US, leading to capital outflows from emerging markets as investors will seek higher returns. Global trade policies. This is changes in tariffs of trade agreements affecting countries dependent on exports, influencing their gross capital. Therefore, geopolitical risk, we have wars, we have political instability, we have sanctions. These can disrupt markets, causing price fluctuations and market crashes. An example is the trade war between the US and China, affecting many emerging economies that rely on exports to these two. Let's look at risk management in emerging markets. We have currency risk management. This is using currency forwards, features, or options to protect investments from exchange rate fluctuations. Then we have political risk management. This is when you invest in countries with stable governments or political risk insurance to protect against expropriation and nationalization. Then we have currency risk management. This evaluates the political, economic, and financial risk associated with investing in a specific country before committing capital. Then we have diversification and hedging. This minimizes exposure to any one market by diversifying investments across various regions and asset classes. By way of conclusion, emerging financial markets present attractive investment opportunities driven by high economic growth, expanding industries, and increasing demand for goods and services. However, these markets are also prone to volatility, political instability, and external economic shocks. Understanding the unique characteristics of emerging markets and employing effective investment strategies such as diversification, currency hedging, and long-term planning is crucial for managing risk and capitalizing on the growth potential of these regions. By influencing risk and rewards, investors can successfully navigate the challenges and reap the benefits of investing in emerging markets. At the end of this module, is an assessment session where there will be 15 multiple choice questions, testing knowledge of the characteristics of emerging markets, of investment opportunities, and risk strategies. Then part B will cover a report proposing investment strategies and risk management techniques for multinational corporations. That was all for Module 9. I'll see you in the last module being Module 10.